Welcome to today's Explainer. We are looking at a massive, and I mean massive, paradigm shift today in how we view money, how we earn it, and ultimately how we keep it. We're going to dive deep into the core strategies of wealth creation, comparing active and passive income, and rewiring that entrepreneurial mindset, all based on some incredible insights from leading financial strategists and millionaire entrepreneurs. Now, I want you to ask yourself a serious question. What if literally everything you've been taught about getting rich is just completely wrong? Think about it. We all grow up hearing the exact same standard advice, right? Go to school, get a safe 9-to-5 job, stash a little bit away in a savings account, and eventually, decades from now, you might be able to retire comfortably. But what if that conventional wisdom is actually the very thing holding you back from true financial freedom? Well, here's the harsh truth we kind of have to confront right out of the gate. Relying on a single active income stream and putting all your faith in that get-rich-slow scheme, it's a trap. When you follow that path, your financial well-being is decided by your boss, the economy, the stock market, basically everyone and everything except you. It puts you in this highly vulnerable position where a single layoff or a sudden market downturn can just wipe out your security. It is time for us to take that control back. Okay, let's dive into this. Here is our roadmap for today. 1. Rejecting the slow wealth myth. 2. Active versus passive income. 3. The elite entrepreneurial mindset. 4. Core pillars of wealth building. And 5. Protecting and growing your assets.
Section 1. Rejecting the slow wealth myth. Stop playing it safe.
So let's break down some of the biggest fallacies out there. First up, people think risk and reward are inversely correlated, meaning they assume you have to take these wild, blind risks to get rich. Not true. Intelligent wealth builders take strategic risks. Second, pinching pennies does not make you rich. Wealthy people don't get wealthy just by skipping a daily coffee, They focus on increasing their income, not just obsessing over savings. And third, the housing trap. Buying the most expensive house you can afford every single time you get a raise pretty much ensures you'll never be wealthy. The real trick is finding the least expensive house you can happily live in long term, which frees up your cash to actually buy income-producing assets. To really drive home why getting rich slow is fundamentally flawed, let's just look at the math. According to self-made multimillionaire Alex Becker, let's say you manage to secure a massive $120,000 a year salary, and let's say you miraculously save half of it, $60,000 every single year for 30 years. You still only end up with $1.8 million. I mean, 30 years of grinding and extreme saving, and you haven't even cracked $2 million. It totally proves that the slow path is mathematically inadequate for building extraordinary wealth. And then there's the traditional investment advice. We are so often told to put 80 to 90% of our money into stocks and bonds and keep the rest in cash. But the sources we're looking at today point out that this is an incredibly inadequate approach to safeguarding and building wealth. The really intelligent wealth builder diversifies their diversity. You shouldn't just rely on paper assets. You actually need to incorporate tangible assets, like income-producing real estate and direct investments in private, cash-generating businesses. Section 2. Active versus passive income. The engine of wealth. We have to get our definitions crystal clear here on these two core types of income. Active income is what most of us know best, right? It's trading your time, effort, or skills directly for a paycheck. If you stop working, the money completely stops. Passive income, on the other hand, is money earned from systems, real estate, or investments that require minimal ongoing effort once they're actually set up. Now, active income pays the bills and funds your jump into entrepreneurship, for sure, but passive income, that is what ultimately separates your time from your money. And the data from Concrete brilliantly illustrates exactly why passive income is vastly superior for long-term wealth. Just look at the scalability. Passive income can scale infinitely without requiring more of your personal time, whereas active income is strictly, literally limited by the hours in a day. Then, of course, there are the tax implications. Active income is heavily taxed as ordinary income, but passive income can very often benefit from much more favorable long-term capital gains and specialized deductions. It's a game changer. But hey, don't misunderstand me here. The ultimate strategy isn't to just abandon your active income entirely on day one. You actually need both. Your active income is the tool you use to cover your immediate needs and, much more importantly, to fund and build your passive income machine. You leverage the stability of your active work to construct the assets that will eventually set you completely free. Section 3. The elite entrepreneurial mindset. Upgrading your mental software. To actually execute these mechanics, we have to upgrade our psychological operating system. We're drawing on Alex Becker's aggressive and foundational framework from his book, The 10 Pillars of Wealth. Becker built an 8-figure business in his 20s, and his core thesis is that without the right mindset, even the absolute best financial knowledge is completely useless. You have to aggressively rewire your beliefs about what you are actually capable of achieving. So the crucial point is implementing these core mindset shifts. First, you must accept that you literally have to be better than 99% of people at making money. You have to reject average. Second, and honestly, this is a big one, accept absolute responsibility. Every little thing that goes wrong is 100% your fault. And this isn't about feeling guilty, it's about being incredibly resourceful so you can fix it. Third, adopt an abundance mindset. Reject the scarcity trap of penny pinching. And finally, you absolutely must focus solely on high ROI activities. Outsource or just stop doing the things that don't directly get you paid. Another massive mental shift is abandoning the what-if mentality for the what is. We are so conditioned to worry about all the unpredictable future risks. What if the market crashes? What if this whole thing fails? Successful entrepreneurs ignore all of that and focus 100% on the absolute simple problem right in front of them today. Solve the immediate hurdle, like simply finding your first client, instead of being paralyzed by hypothetical scenarios that may literally never happen. This ties perfectly into a quote featured in Becker's work from Richard Branson: "If your dreams don't scare you, they are too small." Achieving those scary dreams requires surrounding yourself with highly ambitious, highly competitive people. You are the product of your social environment. So if you want to be wealthy, you have to find friends and mentors who are actively building wealth themselves. To illustrate exactly how to do this, there is this fascinating and honestly kind of brilliant anecdote from an entrepreneurship forum on Reddit. A teenager was asking how to meet wealthy people, and the advice he got? Join a premium high-end gym or a country club. Even if it costs, say, £90 a month, you aren't just paying for the gym equipment. You are paying to be in the close proximity of successful business owners and multimillionaires. It's a highly strategic move to upgrade your entire network. Section 4. Core Pillars of Wealth Building. The Roadmap to Execution. Let's move to the tactical side and see how this builds, looking at the execution roadmap proposed by wealth expert Darius Farrow. It's a chronological journey for your money. Step 1 is self-investing. You must learn a rare and valuable skill while saving enough cash to live on for 6 months just for peace of mind. Step 2 is income generation. Put that newly learned skill to work to create real value and cash flow. Step 3 involves asset protection, keeping what you build safe. And step 4 is capital allocation. Once you've acquired serious wealth, your main job becomes moving those resources around for the maximum return, acting pretty much just like Warren Buffett's Berkshire Hathaway. Section 5. Protecting and growing your assets. The fortress. Okay, so you've built the wealth. Now you have to build the fortress around it. Synthesizing advice from wealth managers like Richard Brothers and the Efficient Frontier framework, protecting your wealth is just as vital as earning it in the first place. You need to minimize legal risk with proper trust structures and tax mitigation plans. And interestingly, you also need to treat the financial services industry kind of like a battlefield. Be incredibly wary of stockbrokers or advisors who just want to sell you their products. Your ultimate goal isn't just to maximize random returns, it's to maximize the overall odds of your financial success so you can fund your life, your retirement, and your legacy safely. And here is a really crucial warning as you're building this fortress. The single biggest mistake people make, especially as they approach retirement, is giving up their active income way too soon. To keep your wealth for a lifetime, your passive income streams, whether from your real estate, your dividends, your businesses, must completely replace and actually exceed your active income before you ever decide to stop working. I want to leave you with a fascinating question to chew on today, straight from Alex Becker's playbook. If you were a freak of nature genius business master, what is the absolute simple problem you would solve today? Stop looking at limits, adopt that elite mindset, and take massive action on your own wealth journey. Thank you so much for exploring these sources with me on today's Explainer, and I'll catch you in the next one.